Well, hello and welcome to this Money Control live stream. I'm Nandita Khemka and joining me is Lata Venkatesh. And we're going to talk about all the major changes, amendments that have been made to the Finance Bill 2023. Now, let's talk about what has been done. In a major blow, the proposal to remove long-term capital gains tax and indexation benefits from debt mutual funds. That proposal has been passed in the parliament today, right? And these debt mutual funds should not have invested more than 35% in domestic equities, right? Now this now will apply to investments made from the 1st of April on a prospective basis and not a retrospective basis, right? And this would impact flows into debt funds, gold funds, international funds, if I may say so. Now, my first question to you is, we'll talk about who it impacts and all that, but why would government make these big changes to finance bill so many months, or in fact a couple of months after budget, and that too suddenly? I don't think anybody was expecting something like this.
Yeah, I agree with you. We normally discuss taxes on the day of the budget. We rarely discuss it on the day the finance bill is passed.
Yeah.
So it does come as a shock that something which impacts about one half of the industry. The mutual funds is a 40 trillion industry. Of that, 20 trillion is in debt mutual funds. You would expect that should be discussed before it is made law. So yes, I think that certainly is, you should prepare the industry. You can't hit them suddenly with a blow and without any discussion.
Right. Now, my other question to you is, this would mean higher taxes and make debt mutual funds unattractive, right? So what is the government trying to achieve? Because now it seems it has brought it at par with fixed deposits.
Okay. Well, I think here we should, we may be exaggerating the impact. Okay. If you put 1 lakh in an FD, every year you're going to pay tax on the income that you get from it.
Interest on.
Whereas if you put the same 1 lakh in a debt mutual fund, even under the new tax regime, it is only when you redeem that you will pay the tax.
Yeah.
And then by the time you redeem, the debt fund manager, if he's smart, would have made some duration gains, moved from one yield to another and booked gains.
Yeah.
So it's not fair to say that it comes on par with FDs. People who are smart enough and understand the benefits of debt mutual funds will still prefer debt mutual funds over FDs, though the difference narrows a bit.
Okay.
We have to give that to them. And even in debt mutual funds, there is a lot of money which are in liquid funds, less than a month and stuff like that. So that part is not affected because that always was paying the normal capital gains.
Right.
They were not getting indexation benefits. It is only those conservative funds, those slightly longer duration funds that are getting affected. So that may be 1/4 of the kitty. And yes, it is a hit. It's not the biggest earner for a AMC.
Yeah.
But nevertheless, I agree with you that from a consumer point of view, there is a hit over there. And because the difference between equity and debt is reducing, because not getting tax benefits, more people will go into equity, which may be a little risky. At certain age or a certain age profile should prefer debt.
Yeah.
Now that option is
Has
getting
narrowed
less
down.
attractive, to be sure. So that category of investors have something to complain, and a little bit of the mutual fund industry also has something to complain, because the kitty will go down.
Yeah.
But I think the people who are going to really suffer will be the NBFCs.
Because they borrow from the debt market, right?
They borrow from this, 5-year, 3-year money from the medium-term duration mutual funds. They are really going to be impacted. The NBFC's yield, I think, will go up by some 30, 40, 50 basis points. I won't be surprised, because less is available. When supply dwindles and demand remains the same, the price, that is the interest rate, could go up.
The debt market rather was pretty nascent and volumes were just about picking up. Do you think this will impact the volumes in the debt market now?
I would think yes. That even if you say, the hit is not very much, there is some hit. So this is not positive for the growth of the corporate bond market. We did speak on CNBC TV18 to some CFOs, to Mr. Sesagiri Rao of JSW Steel, manages a lot of money.
Yeah.
He was pointing to two things. Corporates used to park their extra savings in these debt funds because they are taxed only 20% if you keep it for 3 years. Now, the corporate tax is 25%. If this 20% is not available, why would they put it in those funds at all?
Yeah.
So for them, he genuinely says we are not attracted to these funds under the new tax regime. They were attractive when it was 20% long-term capital gains. But on the other hand, he also pointed out that there is a rule, both RBI and SEBI have been encouraging large corporates to borrow more from the capital market rather than from banks.
Okay.
So the SEBI rule says that banks which have, corporates which have more than 10,000 crore of loans with the banking system should borrow 25% of their incremental borrowing from the debt market. But if the debt kitty shrinks, then even implementing this will make it a little tougher. You
Right.
will be borrowing at a higher yield.
Right, ma'am, with financialization of savings picking up, like, do you think it's a big setback for that as well?
Well, I'm not so sure, because financialization, there are so many other instruments. Insurance,
Yeah,
for
so I was
instance, for
coming to that
the
also, yeah.
for the smaller investor who is not paying premium of over 5 lakh, for them there is a cap.
Yeah.
But for the smaller investor, these guaranteed products, insurance products, will now become attractive. Until now, debt mutual funds were getting an indexation and lesser tax benefit. Now that is not available, probably some of that will migrate. Of course, this is longer term. Insurance money is longer term. Mutual fund typically will attract people who want to take out the money in a few years, say 4 years or 3.5 years. But insurance does become attractive at the margin, because if it is a guaranteed product, an endowment product, there is no taxation at all,
Right.
because it's an insurance product. So clearly, financialization will not be entirely impacted. Their coming to the debt mutual funds, especially to this category, will be impacted. But maybe they will do a little more of insurance.
Coming to what the government is trying to achieve by doing this, is it a move to shore up bank deposits? Also, does it have any connection to what is happening to regional banks in the US to get more deposits into bank, to give access to more deposits to banks?
I would be very surprised if bank deposits go up because of this. Bank deposits inherently are not even beating inflation all the time. I mean, sometimes if you adjust it to tax, they don't beat inflation.
Right.
So, I mean, bank deposits will continue to remain attractive for people who can't be bothered about all the KYCs and the, getting used to the whole mutual fund culture, moving from one mutual fund to another, measuring whether the NAV is good enough, is it always beating FD. So there will be a generation or a category of people who just don't want this headache and who will always keep money in FD. In fact, every individual may choose to keep a little bit of money in FD simply because it is less hassle.
Right.
But I don't think this move is inspired to strengthen banks at all.
Okay.
I think this was the old idea which Tarun Bajaj had once said, that we should not have so many capital gains regimes. We should reduce the number of categories. I think this is moving in that direction, if at all. Of course, it's a very small move, but I don't think this will really encourage FD so much.
Okay. Right, ma'am, your closing thoughts about what has happened today out of the blue, debt mutual funds becoming less attractive, insurance getting more attractive. Who is the most impacted out of this? In a positive way, if not in a negative way?
In a negative way, the debt funds are impacted. So we clearly know who is the loser in this.
Yeah.
In a marginal way, very, very marginal way, you may say insurance and ULIPs, that is, and even equity is a beneficiary, because you're not even getting the debt advantage, the taxation advantage. Maybe a little more will come into equity. The other unlikely advantage could be the Reserve Bank's direct retail plan.
Right.
They were allowing us to open accounts in the Reserve Bank directly, and you could buy G-Secs, government securities. People were not doing that because in government securities, if I buy and I sell, then the entire gain is going to be taxed, the entire interest income. Whereas if I went through a debt mutual fund, I would get 20% capital gains and indexation benefit. Now that is gone. So maybe this product of the Reserve Bank will find some favor.
Well, we'll get to see who are the
But
major
clearly
winners.
the loser is the NBFC. Of that,
yeah.
I am in no doubt.
And the debt mutual funds,
they will
of
have
course,
to pay a
yeah.
little. Those two categories are genuinely the negatively impacted in the changes in the finance bill.
Right, and there's also been some move on security transaction tax on futures options. A lot of confusion
get to
about
the
that.
bottom
We'll
of
have to get to the bottom of it and figure out what the change exactly is. Well, with that, Lata ma'am, thanks a lot for joining in and answering all our questions regarding this very sudden move by the government. And for all our viewers, I hope this answers all your questions relating to this amendment and how it impacts the debt markets as well as investments in general. With that, well, it's a wrap from me and Lata ma'am. But for more news and updates, stay tuned to Money Control.